There is a type of ETF that has become incredibly popular over the last few years, and it is probably costing you more money than you realize. Covered call ETFs like JP, JQ, and QYLD have attracted hundreds of billions of dollars from investors chasing high monthly income. But the math on what they are actually doing to your portfolio is almost never explained properly. Here is the basic mechanism. A covered call ETF holds a portfolio of stocks and then sells call options against those stocks to generate additional income. The premium from selling those options is distributed to shareholders as a monthly dividend. That is why the yields on these funds are so high, often 8 to 12% annually. But here is what that income is actually costing you. When you sell a call option, you are selling someone else the right to buy your stocks at a predetermined price. If the stocks go up above that price, you are forced to sell them, and you miss out on all the upside above the strike price. In bull markets, covered call strategies consistently underperform the underlying index by several percentage points per year. The problem is compounded by how these funds are actually structured. Many of them use what are called European-style options or equity-linked notes that do not perfectly track the stocks they claim to hold. The result is something called tracking error, which means the fund's performance drifts away from what you would expect based on the underlying assets. Let me put some real numbers on this. Since its inception, GPI, the JP Morgan Equity Premium Income ETF, has delivered roughly 8% annualized total return. Over the same period, the S&P 500 delivered about 12% annualized. That is a 4 percentage point annual gap. On a $100,000 investment over 10 years, that 4% annual difference compounds to roughly a $48,000 difference in total returns. Now, the standard defense of these funds is that you are trading some upside for higher income and lower volatility. And that is technically true. GPI's standard deviation is lower than the S&P 500. The income is genuinely higher month to month. But here is what the defenders never mention. If you are reinvesting those dividends, which most people assist in the accumulation phase are, you would have been better off just owning the S&P 500 and selling shares for income when you need it. The total return is what matters for wealth accumulation, and covered call ETFs consistently underperform on total return. These funds make more sense in very specific circumstances. If you are already retired and you need higher monthly income and you do not care about leaving a larger portfolio to heirs, the trade-off may be acceptable. But if you are 10 or more years from retirement and you are putting new money into covered call ETFs because you were attracted by the high yield, you are almost certainly draining your future wealth. The simple alternative is to own a broad market index fund and pair it with a dividend growth ETF. You get the market return plus a growing income stream, and you keep all the upside in bull markets. Over long time horizons, that combination has consistently beaten covered call strategies on total return. The monthly income is lower, but the wealth you end up with is higher.